let's discuss the stellar performance that we have seen from CEAT this time, especially on the margin front with Arnab Banerjee, the MD and CEO at CEAT, joins us on the show. Arnab, hi, good morning. Thanks so much for making time and speaking with ET Now. Let's begin by discussing the margin picture itself. EBITDA margin at 15%, almost doubling year on year. Gross margin almost 43%. Is this sustainable?
Yeah, it's been a very good quarter for us, especially at the gross margin level. As I had been talking about margins, we want to maintain our margins in a narrow band going forward. So our objective is to have predictability of margins, stability of margins, and gradual improvement. So I think if there's no great volatility in the system, we would try to maintain margin in a very narrow band.
That'll be easy to do that, Arnab, given that crude prices have moved up. So I'm guessing the next quarter, the RM basket cost will also escalate.
Yes, crude has gone up and imported rubber prices have also inched up. But at the same time, demand for tires are weak in China, in Europe. So these two things will balance each other out. But you're right, the raw material basket seems to have bottomed out. And there'll be a gradual creeping inflation going forward in Q3 and Q4.
When you say that, you'll try and maintain the margins in a narrow band, and you talked about the volatility in the raw material prices, what could be that narrow band, both in terms of EBITDA as well as the gross margins?
See, when I meant a narrow band, in the sense we don't shift the plans quarter on quarter. We had been continuously focusing on the larger profit pools, which is our two-wheeler business, our four-wheeler business, and now an increasing share of agricultural radials, both mostly in international business. The proportion of this business is gradually increasing quarter on quarter. That's number one. Number two is that we are improving the relative positioning of our products in the market. For example, in Q2, there were a lot of action, but our relative price positioning in both passenger and truck bus radial has improved in the market. So we are not, behaving like a typical commodity player moving up or down with the basket. We're trying to improve the mix and the margin profile so that we can adjust to moderate swings in raw material prices.
Okay. So can I say that 13 to 15% is the new normal for you?
I wish it is, but you can take any number. But as I said, we don't want to go back to 10, and 20% is also unlikely.
Okay. How much of your demand currently is a function of replacement market?
Replacement is critical for us. Replacement and international, both are important. International business is in fact EBITDA accretive for the organization. Between these two, about 70% is the contribution to the overall basket. About 30% is OEM sales.
Okay. Could you give me a split of your revenue, two-wheelers, CV, car, and EV now?
Maybe it's about 1/3, 2/3. 1/3 is truck and 2/3 is non-truck overall, and volume-wise. And within that 2/3, an increasing component is the agri-radials, which is coming up to agri-radials and farm, which is coming up to almost 16-17%. The rest will be passenger.
And what is more lucrative for you? Stick to trucks or expand back to PV and CVs? PVs and
we are
EVs.
Market leaders in replacement in two-wheeler, as you know, so that's important business for us, and we want to consolidate there. Last quarter has been very good for two-wheeler business in aftermarket. The OEM sales in two-wheeler, September was good, but yet to recover to pre-COVID levels. Passenger, it's a very tightly contested market share-wise. We intend to be market leaders in passenger, in aftermarket, and also investing lots in the electric vehicle four-wheelers and two-wheelers. For us, passenger side and agriculture for international business are the larger profit pools that we're chasing. We are also have a decent presence in truck bus radial, but most of the margins will come from non-truck.
Sorry to come back to the point of margin again, Arnab, but I just wanted to get a sense from you. Do you think that 15% what you've delivered this time is the peak of the margin, at least for the next 6 months?
I wouldn't know. It depends on how things play out on the raw material front and how we manage our product mix and pricing. But all I can say is that our margins, we are trying to manage our margins in a very narrow band, which I had stated earlier.
Sure, a word on the balance sheet as well, because your capex plan continue, at 170 crore, I think, in the quarter gone by. What's the plan to reduce the debt going forward? I think it's almost 2,300 crores right now on the books.
No, we have reduced our debt significantly in quarter one vis-a-vis quarter four of last year by 100 crores. Again, quarter two and quarter one, 100 crore debt reduction. So we have come down to about 1850 odd levels now, which is quite comfortable. Our debt EBITDA ratio is very comfortable, just around 1, which is very, very comfortable. So our current year capex guidance has been, for the whole year, has been 750 crores. It might look up to around 800 crores at best. So mostly stable capex plan, and we intend to have bite-sized capex every year so that we can maintain the financial prudence while growing.
You know, when you talk about your vision FY26, and a pretty interesting there, that you're aiming to double your export revenues from the current 2,000. How do you plan to achieve that? What's the roadmap looking like?
There are some key geographies that we have identified. For example, Europe is one of them. And there are specific plans for product launches in this market in agri-radial, in passenger vehicle tires, and in truck bus radial tires. Our passenger vehicle tire, in a very prestigious German magazine rating, Auto Bild, has featured 15th out of the top 35 brands in the world, and it is the only Indian brand to have featured in that prestigious list. And customers in Germany go by magazine rating. So we are investing a lot in marketing. We are going to launch our products, passenger and truck bus radial, in the US by quarter four of this year or quarter one of next year. Latin America is another focus geography. So there are specific product market plans, local sales team, local customer insights, local product development, and local marketing, of course. So we are quite bullish about our international business plans.
Will there be a proportionate level of crude which you can share with us, at which crude will start hurting you and you will be forced to increase prices? What's that? What is the sweet spot for you, and what is the gray area for you?
See, the entire basket is what matters. So crude is one variable which impacts synthetic rubber, the nylon tire cord, and carbon black kind of thing. Then there's natural rubber, and the whole basket doesn't move up together. So right now crude is around 90-ish. If it stays around that or below, I think it's okay.
90 or below is something which you are able to manage. I just wanted to come back to the question of the international geographies, and I'm a bit confused because initially in your comments you did say that demand from Europe and China is weak, and of course you're talking about it in terms of the potential of it as well. When do you expect the recovery in the international markets? Is the demand weak or is it holding up okay?
See, for us, where we have a significant presence, for example, agri-radial in Europe, the recession in Europe will have an impact, and it does have an impact. Where we are starting out and the market is huge and we have very low share, like in passenger radials or truck bus radial, the recession in Europe, it doesn't really impact us, and we are growing handsomely in Europe. Then there is US, of course, which is not in a recession, which is doing well, and we're going to launch the products there. So it will have some impact, but it's not a huge impact vis-a-vis our ambitious growth plan of 2x by FY26.
Okay, on that note, Arnab, we let you go. Really appreciate you joining us and candidly speaking about the outlook as well. So, of course, margin is something that they would want to hold on to and maintain in a steady range. But let's see where it goes from here. The stock has given up some of its gain. It's still holding up with 7% gains, but off the highest point of the trading session. Quickly, let's